as up to half the state's landlords consider selling their investment properties.
38% of investors said they're planning to sell.
In the past 6 months, Melbourne property investors have started to sell off, with the Victorian government continuously imposing additional taxes on investment properties. The investment returns have significantly decreased. Coupled with the current high-interest environment, holding on to investment properties has lost its appeal for many investors. After 3 consecutive tax hikes, Melbourne's newly appointed Premier Jacinta Allan lived up to the expectations. Barely settling into her role, she announced a 4th tax on investment properties this year, igniting the fury of Victorian investors. Could this be the last straw that breaks the camel's back, triggering a new wave of property sell-offs in Melbourne? What exactly changed in the housing market in September, making the future outlook uncertain? What is the underlying reason for the booms and bust cycles in the housing market? Can it predict the future trends of the property market? Hi there, my name is Alex. Welcome to my channel, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. The newly announced tax in Victoria isn't actually a new tax, but an expansion of the tax base. This tax, long criticized by Victorian property investors, is the vacant residential land tax. The tax is levied on the properties in Melbourne's inner and middle suburbs, such as Melbourne, Monash, Port Phillip. Vacant properties are taxed at 1% annually. This tax isn't just on the land value, but the combined value of the land and the building. In Victoria, it's calculated based on the CIV figure on the council rates bill, not the house market price. For instance, if a house worth $1 million remains vacant for 6 months, a 1% vacant tax is due annually. Many landlords, to avoid this, let friends stay for a few days since the electricity meter will record usage, indicating occupancy. This way, when inspected, they can claim it hasn't been vacant for a continuous 6 months. Many exploit this loophole. The Victorian vacant tax is different from land tax surcharge, and the federal government's vacant tax. It applies to everyone, whether local or overseas landlords. You will need to tell the government that it is vacant. If you fail to declare, not only will you have to pay the tax, but you might also face a penalty of up to 90% of the tax amount. Well, now the rules have changed. The vacant tax will no longer apply only to a few inner city areas, but will extend across Victoria. Any property in Victoria that remains vacant for 6 months will be subject to this tax, effective from January the 1st, 2025. Well, but that's not all. Starting January the 1st, 2026, the scope of the vacant tax will expand again. But this time, it's not about geographical expansion, as the whole of Victoria is already covered. Instead, it will target vacant residential lands in the metropolitan Melbourne area. If a property in this region remains undeveloped for 5 years, it will be taxed. Developers, land banking investors, individual land buyers, and even some government agencies that hold land without building on it will be subject to this tax. The Victorian government claims this is to change the behavior and encourage more housing construction. However, the public perceives it as the move to increase tax revenue to cover the massive debt incurred during the pandemic. Earlier this year, Melbourne decided to lower the land tax threshold to $50,000, resulting in an additional 860,000 properties becoming taxable. This tax is levied on the land value of investment properties held in Victoria, excluding primary residences. Well, essentially, if you have an investment property, you will likely have to pay this tax. This was the first negative news for the property investors this year. When I heard it, I was furious. Then came the news of Melbourne's restrictions on the frequency of long-term rent increases and the prohibition of evicting tenants without a valid reason. This was the second blow. Following this, the government introduced additional fees for Airbnb bookings, annual license reviews, and also imposed restrictions on rental durations, further reducing the profitability of property investments. This was the third move. By the time the new Premier announced the expansion of the vacant tax scope, the 4th negative news, I was kind of expecting it to happen. Perhaps this is the trend in Victoria. Now, investing in property in Victoria requires careful planning. It's not that you can't invest, but the returns are not as they used to be, and they're likely to decline further. If you're investing in Melbourne, you have to accept this reality. So, what exactly happened in Australia's housing market in September? What new trends emerged, and how will they shape the future? In September, the Australian property market experienced another rise, making the 7th consecutive month of growth in this current upward cycle. Sydney saw growth for the 8th consecutive month with a 1% increase in September. Melbourne rose by 0.4% and Brisbane by 1.3%. The growth rate of housing prices in the three major cities on the east coast remained consistent with August, while Adelaide and Perth are still accelerating. Hobart and Canberra, on the other hand, are in the flat bottom phase. From the trend charts, it is evident that the growth rate in Sydney and Melbourne has peaked. Prices are still rising, but not as rapidly as in the previous 2 months. Brisbane's upward trend remains consistent, while Perth and Adelaide are still in acceleration. Compared to the previous bottom in the housing market, Sydney has seen a cumulative increase of 10.6%, Melbourne 4.3%, and Brisbane 9.1%. To summarize the September housing market in a few words, firstly, there's a slight deacceleration in the national housing market's growth rates. Consistent with our expectations from the June live webinar, the main reason for this slowdown in price growth is the increase in the number of properties listed for sale. At the same time, the demand hasn't changed significantly. Adelaide, Brisbane, and Perth haven't seen a significant increase in property listings, hence their robust price growth. So far this year, the national housing price has risen by 6.6%. By November, the price will surpass the peak during the pandemic. If you own a property bought at the pandemic's peak and can hold on to it until next year, the potential for profit would be much higher. In Sydney and Melbourne, the high-end market's price growth has significantly decreased, while the mid- and low-end property prices remain strong. Oz Property Strategy's perspective is that both house prices and rents will continue to rise. Those without properties will see their wealth diminish, while property owners will see their assets grow as house prices increase. In the short term, there won't be any fundamental changes on the demand side until the entry barriers are lowered. Factors like a continuous population boom, leading to a persistent increase in housing demand, or fiscal subsidies, tax cuts, monetary policies that release more currency and reduce interest rates, as well as easier credit access and increased lending capacity, could play an important role. Without these factors coming into play, it's challenging to see a fundamental increase in demand. So, what will be the future trend of Australian housing market? Is there an invisible force that can determine the property market cycle? Over the past 40 years, Australia's property market has seen numerous booms and busts. Some attribute these fluctuations to economic factors, population dynamics, and interest rates, while others point to fiscal policies, infrastructure, and scarcity, among other reasons. In our previous videos, we've discussed the factors determining the housing price, such as the population and leverage, which essentially encompasses most of the commonly mentioned reasons. Today, we'll delve deeper to explore a factor that has yet to get much attention: the debt cycle. Historically, there's a strong correlation between the debt cycle, economic cycle, property market cycle, and even various asset cycles. The debt cycle is straightforward to understand. During economic upturns, people's confidence gradually returns, consumption warms up, corporate profits rise, and there's a greater willingness to borrow, accelerating economic activity and output. As a result, the total debt beginning to climb. This leads to the second phase, the economic boom. Here, people are extremely confident about the economy and the future, leading to increased investments and consumption. They take on even more debt, boosting profit margins. Corporations also borrow heavily for expansion and investment. Inflation becomes more pronounced, and the total debt starts to skyrocket. Central banks, noticing the overheating economy, begin to cool things down by raising interest rates, making borrowing more expensive and prompting deleveraging. This is when people find it increasingly difficult to borrow. Stock markets feel the pressure and a reverse wealth effect emerges in the economy. Everyone starts to feel their future wealth diminishing, leading to increased savings and reduced investments. Stock markets decline, businesses scale back and start laying off employees, unemployment rises, and the total debt significantly reduces. People begin deleveraging and repaying their debts. And this marks the third phase. The fourth phase is the economic recovery. The government, seeing the economy on the brink of stalling and with high unemployment rates, start to lower interest rates to protect the economy and employment. Businesses and individuals start borrowing again, and the confidence gradually returns. Then the debt cycle repeats itself. This is an oversimplified understanding of the debt cycle. The economic and property market cycles are closely linked to the debt cycle. Economic and stock market cycles are directly related to the debt cycle. More debt boosts asset prices and economic vitality. If you are observant, you realize that we are in the third phase of the debt cycle, given the high interest rates, the high cost of borrowing, and many feeling the pressure of repayments. The trend of Australian stock market over the past 12 months is very similar. For the property market cycle, the debt cycle is just one crucial factor. While property is an asset whose price is influenced by debt, it is also a necessity directly related to population or supply and demand dynamics. Our research indicates that while the property market cycle isn't directly related to the debt cycle, they're closely intertwined. In other words, while the debt cycle influences property prices, the ultimate determinant is the supply-demand relationship. The upward trend of the Australian property market will continue to weaken in the coming months until there's noticeable economic downturn, a stock market crash, and a rising unemployment. When the Reserve Bank of Australia steps in to rescue the economy by lowering interest rates and introducing various fiscal and monetary policies, that will mark the starting point of the next property market boom. If you made it this far, please give me a thumbs up, subscribe, and share this video with your friends. Turn on the notification bell to watch new weekly videos. And follow me on social media at RealCoachAlex. I'll see you in our next video. Have a good one. Bye.